At 8:44, we know investing for retirement is important at any age, but the same strategy and risks should not be used for every stage of your life. There are some steps you can take at every age to put yourself in a stronger financial position. Joining us to explain how much risk we should take is Ernie Burns from Burns Estate Planning and Wealth Advisors. Good to see you. Good morning.
Morning.
All right, so I'm not super well versed in investing. I do my 401k, but I don't play around with stocks or anything. What is risk?
Risk is how much return do you want for your money? And the more return you want, let's say 10+%, you're going to have more risk. In other words, you might be buying a Bitcoin, which is very risky in a sense, to a degree, compared to a Walmart stock or to a CD. So there's different risk tolerances from the tools and investments that you're buying.
Okay, so now that we have that established, for those approaching retirement, how much risk should they have?
Well, you need to dial back that risk. A lot of people get caught in the mutual funds or the investments they've always had in their 20s and 30s and 40s and 50s, and then looking at retirement in the 60s. At that time period, you want to make sure you dial back those same investments to more tolerable returns that you're okay with. You know, don't expect a 15 or 25% return, because if you get that type of return, you're going to have that much loss or more. Dial back to be a little bit more reasonable to maybe a 5 to 10% return, so therefore you can handle the downtimes also.
Okay, so look at dialing back maybe a little bit on some of those things. Tell us the importance of mixing different investments.
You want to be diversified, because at different times of the year, you're going to have oil take off, you might have retail doing well, and you might have finance doing really well, and technology on fire. So at those times, you want to make sure that you're prepared when those sectors take off, you have something invested in those sectors.
What about the people who've already retired?
That's where you really want to dial back the risk and be more confident towards, or more aimed towards, dividends, interest-bearing accounts that are actually giving you some type of return no matter what the market's doing.
And folks who are maybe younger, not really looking at retirement anytime soon?
Anytime there's a downturn, plunge more money into the market if you can afford it, you know. Right. The bigger thing about the younger generation is making sure you're not charging everything. You're not using that credit card as a monthly check.
Right.
Okay. Just because you have that credit card, you want to make sure that you're not using all those funds and getting used to those, using that card over time and time again. Because interest rates right now are at 30-year highs, and they don't look like they're dialing back anytime soon.
So if you have debts with the credit card, it will take a mighty long time to whittle that down, pay it off. Let's talk about investing, and especially right now. Should we be cautious? I know the Feds will be meeting later this week. Is that something to watch?
Well, yeah, we've been fighting this inflation scare for now 2 years, you know, so therefore we want to make sure that we're prepared for it and basically trying to be proactive than reactive. There are some investments in the market right now. If you're very targeted and very cautious, you could buy investments that are basically been deflated for no reason, or because the overall market's down. But in the same instance, don't look at the Feds basically lowering interest rates multiple times this year. Maybe one time now, because inflation has not subsided. It has actually creeped up a little bit the last couple of months. So expect the Feds to be hawkish for the future and be cautious how you're investing.
Okay, good advice, Ernie Burns. Thanks for being here.
Thank you.
All right, coming up,